Mohnish, the Dhandho Investor has now been out for a dozen years, and you've had experience to learn from successes and mistakes in that time. How would you perhaps update the book? Would you add anything to it? Are there nuances that are not in that original version, but that would be in another edition?
Yeah, I think one of the things I would correct is there's a mistake in the book in the way the Kelly formula is applied. And the Kelly formula actually is not very relevant to equity investing or value investing as most of us practice it, because the underlying assumption is that you can make the same bet kind of thousands of times. Kind of like, if the odds of a heads is 51% and the odds of a tail is 49%, and you get to bet that once, if you just get to bet that once, it's not very useful to have that kind of edge. But if you get to make that bet 10,000 times, and you can always bet on the 51% each time, you'll do very well. So the Kelly is useful when you get these, serial betting opportunities, which is quite different from the way equity investing works. So one of the things I would change in the book is I would completely take out the entire discussion on Kelly because it's not relevant. The other thing I would do is I would probably spend more time on the downside protection and the free lunches. I think the thing is that the book does talk about how markets hate uncertainty, and they confuse kind of risk and uncertainty. And so Frontline, which was the VLCC company, had massive uncertainty, but it had very low risk. And so when you have the combination of very low risk and very high uncertainty, the same thing in IPSCO, the steel company, extremely low risk, extremely high uncertainty. Usually the combination of those two will mean extremely high rewards, because markets will misprice those quite significantly. And so if you have an edge in terms of understanding those businesses and like understanding kind of the dynamics, then it can work out quite well. Like I don't know whether I should mention this, but I'll go on a limb and say this. One of the businesses that I think we're almost at the tail end of buying is a company which basically in the next 5 years will generate cash flows equal to or higher than, actually probably higher than the market cap. So in effect, and those are pretty much just like IPSCO contracted cash flows. So they're locked in. So it's not just giving a multiple. You actually have visibility into kind of 2022, 2023 type numbers. And the company is probably going to dividend out these cash flows as they come out. So for example, if I invested $50 million in this business, and $50 million of cash flow, or maybe $70 million of cash flow will come in the next 5 years, and that entire 50 or 70 million gets pushed out. Then in 5 years, I've got my money back. In fact, some of that started coming back a year from now. But I still own the business, and I still own all the assets and plants and equipment and all of that, just like IPSCO. So I like those types of bets. But if it doesn't play out, with the bull case, in this case, we won't lose any money. We probably make some money. But if it works out with the bull case, then we make a lot of money.